Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, November 19, 2018. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. It was an ugly day out there. There's no doubt about it. If you owned anything, it was down. It's just the way it worked today. We're going to get into the whole ball of wax. No question about it. I'm going to give you my thoughts on both sides, and I'm going to tell you exactly what I think this was. In fact, there were a lot of clues out here today. Make no mistake about it. We're going to be busy tonight. So before we get really going, let me first thank everybody for continuing to participate and make comments and posts underneath the videos. Please continue to do so. I love the interaction. I thank everybody that participates. In addition, hit the like button on the video, please, and share the video with anybody that you think can benefit from this information. All right, so let's get right into the daily chart. So let's pull back a little bit and let's step back a couple of steps. And let's think about what the big picture is. We're looking for a low. Okay, fair enough. We might have found a low last week on Thursday. The market went up Thursday. It reversed intraday. We had some follow through on Friday. The market did not close above a breakdown candle high. It did test it, but didn't close above it on Friday, and today we went back down. Okay, was this an expected move today or an unexpected move? Well, let's say it like this. I wasn't expecting a down move like this. I was expecting more follow-through coming out of the weekend. I thought there would be some buyers coming out of the weekend into a Monday feeling like we bottomed. That's the way I felt going into the weekend. Market doesn't care how I feel, doesn't care how you feel. Market doesn't care how anybody feels. The market's going to do what the market's going to do. It's our job to try and interpret it the best we can and trade off of that information. The market's designed to trick, trap, fool, and frustrate as many people, as many traders, as many investors, as much of the time as possible. That's just the way it is. There is nobody exempt. So what do we have going on here? Well, it's pretty apparent. You don't have to be a rocket scientist. You don't have to be an MIT graduate. In fact, you don't have to be any graduate at all. You don't have to have a high school diploma to know that this is an important low. And if you're unsure that it's an important low, take my word for it, it's an important low. So how do we use that information to our advantage? Well, if the market's going down, we're going to use that on a closing basis. We're going to use it for hourly closes. We're going to use it for daily closes. I really didn't want to see the market spend a lot of time down at 266. You'll remember that from last week. We talked about this. I said, and this was before the market bottomed, I said, it's okay intraday, but I'm not sure I want to see hourly closes down in that area. That means there's likely something else going on. I really don't want to be a part of it on the long side, at least until I was to have some kind of clarity of the situation. Okay, fair enough. Well, we're not down there now, so we don't need to continue to talk about it. But what I do want to say is that still is a possibility. If we begin closing hourly below Thursday's low right down here, then we don't want to be long the market. There's going to be downside selling pressure in the market. However, listen carefully to what and how I say this. On hourly closes below that level. So let's say, for example, you close an hour below Thursday's low one time. Does that mean the market's going to collapse? No. Can it go down farther, a lot farther? Yes, it can. But you start to close 2 hours, 3 hours, the evidence begins to mount that it's not bullish, it's bearish, right? You don't have to ever really overanalyze this stuff too much. If it walks like a duck and it talks like a duck, it's a duck. And sometimes when you get up real close, it turns out to be something else and you say, holy cow, I got tricked. And there you have it. But the reason I bring that up, not about the duck, but about the low, is because it's not uncommon for the market to spike through that number, Thursday's low, intraday, intra-hour, even just for a few minutes, and then reverse back up, and then they rip it up one more time, and that's a full test of the low, and then they take off from there. I'm not saying that has to happen. I'm saying that certainly can happen. It happens all the time. It happens on 10-minute charts. It happens on hourly charts. It happens on daily charts. It happens all the time. So net, what's changed? Has anything really changed from a bigger picture perspective? Not yet. Have we closed below 269 yet? I don't think so. Wasn't that an important number? Yeah. Here's an hourly chart. We hung around there pretty much all afternoon. Here's a 10-minute chart. You can see we hung around this particular price area all afternoon. Came to backtest it when we broke above it. And when we tried to get above it the first time, it was rejected. So I'm not saying that 269 even is the number that we have to watch every single day. I'm just saying I'm keeping the line on the chart because for me, from a logical standpoint, wait a minute, here it comes. From a common sense market analysis standpoint, it looks like it's important. Look what happened at the end of the day. The market ran up and closed above 269 when it was below it 10 minutes earlier. Does anybody think that's an accident or a coincidence? I don't. Think about what I'm doing here, folks. I'm not giving you a set of rules that say you take a trade if and only if, or you don't take a trade if and only if. What I'm trying to do is trying to get you to think differently about how the market acts and reacts, how it operates, to notice the things that people just don't notice day in and day out. Those are the things that are in my course at Lazy E-mini Trader. Back on the daily chart, let's kind of flip it around. Let's talk about the other side. I think, very dangerous word in this business, I think, right? But here's really what I think. And I'll be proven right or wrong. Doesn't matter what I think. I'm telling you what I think, but I'm giving you my analysis as my analysis is. But we're taking a pause and I'm telling you what I think. I think this was a rope-a-dope. And so I think this was a quick test of the low. If tomorrow I'm correct and the market is up and we begin trading higher and we can get some follow through, they'll trade higher in through Thanksgiving, into the weekend, into the shortened session. I believe it's a shortened session on Friday. And folks, the reality is that's the way the market normally works around this time of the year. That doesn't mean anything. It doesn't have to work like that. You can certainly find years where it didn't work like that, but the majority of the time, that's the way the market's supposed to work. It's almost like an unwritten rule amongst the trading investing community. We'll see if they read the rule this week. You know where the bogey is on the upside. Today's high. You begin closing hourly above today's high, you're off to the races. They'll take the market higher. Now, all that being said, we can't discount the fact that the spider was down over 1.5% today, over $4. The S&P 500 was down 45 points. That's a big down day. That hurts. Anybody holding anything long was hurt today. That's just the way it worked. IWM. We didn't get any kind of bullish clues from the IWM today whatsoever. We got the opposite effect. We get leading the market to the downside, down 1.8% in the IWM. Last Thursday's low holding by the skin of the low. If that doesn't hold, IWM's a tough customer. If that doesn't hold, there could be some painful decline down to here, about 146, 146 and a half. The reason why I say painful is it probably will not be slow. That's if you begin closing hourly below Thursday's low. How about the transports? What are we getting in terms of a signal from the transports? So we were down less than 0.5% in the transports. Does that look like a bullish or a bearish chart setup or chart pattern to anybody out there? The IWM is my favorite market leading indicator in either direction. It really is right way more than it's wrong. My second favorite market leading indicator are the transports. It's also right way more than it's wrong. In fact, the transports were the canary in the coal mine on the last two major turns for us, maybe more than that, but certainly two that stand out. The two last turns that stand out in my mind, the transports were signaling ahead of time, and they haven't steered us wrong. So when something works, you continue to use it until it doesn't work. In fact, the transports have been working for me for a very long time. Years and years and years, they continue to work as an indicator, as a leading indicator of the markets in either direction. Right here, right now, until and unless we close below Thursday's low in the transports, and that's far away, you really have to have a big decline across all markets globally in order for the transports at this point to close below Thursday's low. If in fact that happens, something else is going on and markets are trading a lot lower. But what the transports are telling me right here, right now is that this was a rope-a-dope and the transports are signaling higher prices. That's what this chart tells me. Be careful how you take that. That's what this chart tells me. That's not what the other charts are necessarily telling me. I told you what I think. I told you where hourly closes and daily closes are important. I'm telling you what the transports look like. These are all puzzle pieces that go on the table. They get put together. We got to slide them around a little bit to see what fits with what. And when the picture starts to become clear, well, you know what happens after that. So very simple. Our bogey on the downside in the transports is Thursday's low. Once we get above Thursday's high on an hourly and then daily chart close, the transports will begin to trade higher. The moving averages above will provide overhead resistance along with this particular price level right here that today coincides with the 50-period moving average, but that'll change as everything moves forward in time. But just for argument's sake, call it 10,800. That's going to be a lot of overhead resistance for the transports. Technology got taken out behind the woodshed. Holy smokes. Down 3%. The Qs were down $5. Coming into October lows. Look where we closed today. Anybody find this interesting or a coincidence? So look at the low here. The low was 162.02. That was on the 30th of October. So I'll slide this over so everybody can see the numbers. Look where we closed today. 162.06. Accident or coincidence? Not likely. So let's see if that holds. Then the next stop is the October 29th low, which happens to be 160.09. So there'll be a fight down there, of course. But something had to be worse than all the rest. And in this case, it's obviously the Qs as a result of the fact that Apple and Facebook and all these other names, everybody runs for the exits at the same time. We talked about this dozens of times. These are the fan favorites. That's why I call them fan favorites. All the hedge funds own them. All the mutual funds own them. Everybody owns these names in one way, shape, or form, whether they even realize it or not. Everybody can't get out of the movie theater at the same time. It just doesn't work like that. Before we wrap up on the Qs, it just is what it is. So it's this low here at 162.02. Hourly closes are likely going to send the market down to test the day before's low, the October 29th low at 160.09 or somewhere in between. If we get the reverse and the market starts trading higher, there's a lot of damage to be repaired from today's down day in the Qs, but everything and anything is possible. Today's high is the bogey. That's the way we work the market. We'll take a look at a few stocks, but before we do, there's always a story within the story. Here's a picture of the XLF, not down today at all. The XBD, the broker-dealer index, got taken out behind the woodshed, $3.50 or about 1.3%. But the XLF, which has different components than the broker-dealers. The broker-dealers are Morgan Stanley, Goldman Sachs, bunch of other firms like that. But the XLF, Bank of America, Wells Fargo, JP Morgan, PNC, and many others. Don't we always discuss that unless the financials are really breaking down, it's unlikely that the market's going to really break down? How many times have we had that discussion? I'm just going to take this at face value and say it's relative strength in the financials. I don't need a reason why. I don't need 32 news articles to give me the reason why. I just need the chart, and I need the price action being up today and not down with the rest of the market that was down enormous. I just need that piece of information to tell me all I need to know. On the other side of the equation, the SMH, along with everything else in the tech space, got wrecked today. In fact, I'm going to retract the word wrecked, and I'm going to replace it with absolutely smoked. 3.75%. Closed below this low here. That's not good. You see what we're coming to if, in fact, the market does not go higher tomorrow. If there's not a repair job in store, then they're going to run for this breakup candle low, which comes down at 88.75, 88.80, somewhere down in that neighborhood is where they're likely going to be headed. That would be a tough slog from here. Only because it would likely be in one shot, so it's another couple of percentage points down. Here's a snapshot of Amazon, and this is a good example of why I kept discussing what I was discussing in the spider chart. Let me go back to the spiders for a second. Here's the daily chart. Remember I was discussing down here at 266 or in that neighborhood, I really didn't want to see the market closing daily below that level. In other words, this is a breakup candle. I didn't want to see the market give away on a closing basis more than half of that breakup candle. I would take that as negative. There's no rule you're going to find anywhere written in any book to any effect like that. That's my rule. That's the way I use that information. Doesn't mean it's right or wrong. Just in this particular case, that's what I didn't want to see. Does it mean that every time we have the same type of setup, the same thing applies? No. I'm just telling you this time, I just didn't want to see that. I don't want to see that. Here's Amazon again. That's where we are in Amazon. That's not a bullish sign to me. That means that they're likely going to make an attempt to test that low. And if they test that low and that low fails, there's lower prices coming. Where might you ask? Right there is where I think. Looks a little similar to Apple, I think. We'll take a look at Apple in a moment. You can see from a generally speaking perspective that this area, there's what's called a lot of chart vibration in here. The price went back and forth. You can tell that in this general zone is important. We rallied up to there. We back tested it. We broke out from there. The market's coming back to test a former breakout area. Now Amazon's going to have another test. We'll see what it's made of. Apple. So here we go on Apple, down below the low from last week, and maybe I'll get the 183 after all. If the market's selling hard, is 183 a hard number that we should hit and bounce off of like a rocket? No, not necessarily. That's where I would buy Apple for a longer term swing trade position, not a scalp trade, not a day trade. So we could go all the way down to this particular low down here. That comes down to probably 180, right? The low is 180.73. So somewhere in that zone, I'm willing to pick up Apple for the longer term, meaning when the market finally does rally, Apple should have a recovery from in and around that area. Remember, these lines were on this chart before Apple got to this price. I only say that to avoid the messages from the people that say you just put the lines on the chart. I don't even know what to tell you on Facebook. I told you that this thing looked ugly. It was in a downtrend. Remember, we looked at this chart on a weekly, and we said at the time that there's never just one cockroach. That is one ugly, ugly reversal. Lower prices are coming. Look what we're doing. There's almost no end in sight, but of course there is. But it feels that way if you own Facebook, because now you're owning it on hopium. You're hoping it finds a rally, finds a low somewhere soon because you bought it a lot higher. The people that bought it down at $30, they're not worried about it. It's the people still in from 175 that are worried about it. Here's what I'll say on Facebook. I don't know where Facebook will find a low anytime soon, but I will tell you where I'm willing to buy it. Right in that zone there. Call it 116, 117, 119, 120. Somewhere in that zone is where I'm willing to step up and own Facebook, but not until there. So I'm not saying that it will get there. I don't know if Facebook bottomed today and maybe it goes straight up tomorrow. It will do so without me. What I'm saying is that if Facebook gets below 120, I will be a buyer of Facebook. And what I will tell you is if it happens anytime soon, it will not be an easy thing to do for anybody. It will feel very, very wrong which is generally very, very right. Netflix. Where's Netflix going? It's falling and it can't get up. Where am I a buyer of Netflix? Well, before, when it was falling, it bottomed at 271.21. I was a buyer at 262. Will I be a buyer again at 262? It's possible. I have to make that decision in real time. Maybe it goes slightly lower. Somewhere in between 255 and 262 is where I'll likely want to nibble at Netflix. Why do I say nibble at Netflix? Well, because when you look at the weekly chart, it doesn't have to get here, and it could take a long time to get here, but I have this 100-week moving average down here at 240, and it's just in my vision, and it's a really, really strong area right now. Like, if it were to get there right now, I would buy Netflix with both hands. You have a pivot low here, a 100-period moving average. You know, I mean, if you're going to take risk, this is a spot where you take risk. Your stop out, well, I'll leave that one to the imagination. I don't think it's going to get down there anytime soon. We'll see. In between 255 and 262, I will be looking at Netflix make decision in real time. Google. This is Google L, Alphabet. Does it have to get to 1,000? Is that what's going on here? Before, Google got to 1,007.20. Let me show it to you in a different way. 1,999, somewhere in that neighborhood. You see where Google wants to kind of get back there, and do you see why I would suspect that there would be a lot of chart support in that area? You should be able to see that from nothing other than a common sense perspective. And if you don't, you're going to in a moment. I'm going to show it to you right here. Okay, market rallies up, rejected. Rallies up, rejected. Busts through, okay, comes back, tests it here, tests it here, tests it here, okay, misses it here by $7, okay. Do you think maybe it goes down by a few dollars into the 900s, but do you think the market is likely to be supported and around 1,000 again? Yeah, I would suspect so. It's things like this are precisely where I got common sense market analysis from. That's all that was to me. Most people don't look at weekly charts, so they see this at best. In fact, most people look at stuff like this, a 5-minute chart. All they see is a couple hours worth of trading. Now, when I say couple hours, I'm exaggerating, a few days, several days, however they have their charts set up. But the point is, you don't really get any kind of big picture information from a chart like this. You have to go to the larger picture to get what's really happening in the big scheme of things. Once you understand that, it helps you when you drill down to trade from an intraday perspective. You have a big picture in the back of your mind. Alibaba, 3% down day. I'm in this one. It's not a happy day for Baba owners today. You have a gap down here, 20-period moving average. I can't be shocked or surprised to see Baba trade down that way if, in fact, the market is selling more. If, in fact, we get a turnaround, Baba goes right back up in the other direction. I have more plans on the upside for Baba. JD, I'm also in this one. By the way, traders who have taken the course know exactly where my stop is on this one. I'm underwater. This was an ugly decline for JD. I have a stop. Traders who took the course know exactly where that stop is. If you want to test yourself, try me. Let me know where you would think the stop is on JD. Not everything was down today. Remember the TLT. We don't talk about it every single night. This is the bond market. This is when I bring up and discuss the bond market. We talked about buying the bond market. Let me refresh everybody's memory. You get a refresher when I bring this chart up. It was anywhere around 112, 113, 111.50. In that area was a likely area where the bond market was going to find support. Now keep in mind, this is also the same bond market which is opposite yields. These are the same yields that the media has been telling you are going to continue to rise. And as soon as they got extremely bullish yields, meaning telling you where the 10-year and the 30-year were going on the upside, that's at the point in which yields decided to stop going up and come down, which is also coinciding with the same time bonds, meaning the price of bonds themselves, these are treasury bonds, decided to stop falling and go up in the other direction. The two trade opposite each other. Bonds trade opposite yields, yields trade opposite bonds, everything trades opposite the media. Just for fun, why don't we put up the chart of natural gas? We had some fun last week, or at least I had a little bit of fun last week, but we had some fun discussing natural gas last week. I mean, look at that movement in natural gas. It's just on the verge of, or at least it surpassed, ridiculousness. But here was that price level that I put up, I don't know, a few days ago, $38.85. What was today's high? Okay, today's high happened to be $38.83, missed it by 2 pennies. I mean, you really can't make this up. Switching over to gold, gold's doing what we thought it would do. It bottomed where it was supposed to bottom. It's gone up. It actually went right through the moving averages, continues to go up. Now we're above the last breakdown candle high. What does that tell us? It tells us, yes, we're likely going up to 1240. We'll discuss it after and when it gets there. I changed my mind a little bit. I had to lower that one. We'll call it 1232.50. That's going to be some resistance. Not saying we can't get to 1240, but if I was long, I would be taking some profit around 1232.50. About crude oil. Crude oil did a little bit of a rope-a-dope today, testing the low from last week and finishing near the highs. That's interesting in and of itself. That tells me that it's likely that crude oil wants to go and test the high of that breakdown candle, or at least close to it. We know 57 was important, and now we just recaptured 57. That smells like 59. And with that, folks, I'm going to give it a wrap here. It's everything I wanted to and intended to discuss. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.